Well, hello, folks. Brandon Chapman with you. It's a Monday video for TheoTRADE. It is January 8th, 2023. And boy, oh boy, what a day in the market. Opening at the lows, closing almost at the highs on the SPY. The market went screaming today. And the big question is this the beginning of a new bull market? Meaning what? The rally that we saw off of our lows beginning back on around October 27th off of the lows. Is this just a continuation of that bull market, or is this just a relief rally? We're going to look at some of the stuff that Bostic talked about. Fed President, Atlanta Fed President Bostic said today. We're going to look at the volatility markets, and we're going to gauge, is this the beginning of something new, or is it just a relief rally en route to further downside ahead of key data coming up this week in terms of inflation and bank earnings? Well, let's get going here. So again, what did Bostic say today? Basically saying, look, we're not there on inflation. He feels we're progressing towards to the 2% inflation target. Suggests that we probably shouldn't see rate cuts till third quarter of this year instead of the March expectation the market's thrown in. And in fact, if we look at that right now, let's just go to the CME Fed probability tool and we'll look at March. And I probably should refresh this because I refreshed earlier in the session. But have we reshaped expectations and yet the market rallied anyway? The answer is no. I mean, look, 60%, add 2.9, that's about a 63% probability of a Fed rate cut. That's down from where we were a week ago, but we're certainly higher than we were a month ago. And so the point is that we've had a significant rally out of the market starting off of the lows on October 27th. In today's discussion by Atlanta Fed President Bostic, look, I mean, it doesn't really promote the upside, and yet the market rallied anyway. We're paring back some of the probabilities of a Fed rate cut in March, but what is the market focusing on right now? And so let's take a look at some of those things. In fact, let's start off by looking at today's S&P 500 sectors and seeing the leading sector. Notice it says technology and cyclicals. Well, what do technology and cyclicals provide for us? The fact of the matter is they're the two highest beta sectors in the market, as evidenced by SPHB. So again, I have not recently updated it, but again, as of like a month ago, these were the two highest beta sectors of the market. So it makes sense after a few days, we were down bigger, we're down smaller, we held on Friday, that we might be encouraged to take some risk here. The fact of the matter is we were a bit oversold. In fact, if I just bring up SPY right now, we can look at the expected move for last week. This is Don's expected move study. It's the auto expected move. He also does drawn lines for our TheoTRADE clients. But notice how last week we finished. Let's drag this down here. Notice how last week we finished below the expected move. When that happens, you expect things to probably come back. And in fact, we have today. And if we look at the auto expected move, notice this. Today, we are breaching or currently above the upper expected move. And so we went from oversold to now overbought. Now, why? Again, look at technology and cyclicals leading. What leads to these kinds of moves? The idea is that frequently investors will go back to what worked previously. And previously, what did work well? In fact, let's just bring up XLK plus SPY, and we'll bring up the pairs ratio study, and we can see how this has fared relative, how XLK's fared relative to SPY. Notice that going back to like about Halloween of last year, notice that the yellow line's generally rising, meaning that technology outperformed the S&P 500 going into December. December it underperformed or equal performed, and starting in January, it underperformed. The fact of the matter is that technology is and was oversold. Now let's look at that same sector and consider the expected move study, the auto expected move. Notice that last week, not only were we below the expected move, we were probably over 2 times the expected move below. So let's go up here to studies, edit studies, And in this study, I can edit the properties and say, let's go 2 times the expected move. 2, okay. So we're looking at the 1 standard deviation range here. Now we're looking at the 2 standard deviation range, meaning the S&P was below the 2 standard deviation range. This is not a bad time to consider taking a bullish trade in XLK. In fact, using our in-out spread rules for that, this would provide a bullish entry, assuming the pricing's good. Well, guess what? We just bounced back significantly today, up 2.51%. Let's take a look at XLY from the same perspective. XLY was over 2 times the expected move below the previous Friday's close, which was up here at around 179.45. Sorry, 178.85, 179.14. So point being is that we saw a significant sell-off last week, more than 2 times what was expected going into the week. So to have a bounce back today should not be exactly underestimated, right? We might have expected it, in fact. But today, we're close to the upper expected move on XLK. We're now close to the upper, well, we're not that close, actually. This is 2 times the expected move. I got to flip it back. Let's go back here. Edit properties. Like, this doesn't look right. We'll go back to 1 again. Okay, and okay. We're at 1 times the expected move on XLY. And if we look at XLK, we're beyond the upper expected move for this week today. So in essence, what happened? Today, we basically blew out all of the expected movement for the week. Now, it doesn't mean that we can't move higher, but it just proves a point right now, right? Is this the beginning of the new bull or a continuation in the bull market from late last year off of our October 31st lows down here, 27th? The answer is probably no, right? The fact of the matter is that we held the last several days. It provided an opening today for shorts to cover in these specific areas. Are we rotating back into technology and cyclicals away from, let's go 3 weeks here, away from healthcare and staples and utilities, which were some of the better performing, along with financials and communications? And in fact, the beginning of last week, or the beginning of the trading year, you'll notice utilities and healthcare and staples were the top 3 performing. Well, look at the big bounce we had last Tuesday after the first. Big jump, right? Rotation into staples, rotation into utilities. In fact, utilities now outperforming the S&P as of last Friday over a previous 4-week rate of change or 4-week period of time. So what we saw last week was rotation to non-cyclical names. Look at healthcare. XBI performed fantastically today. The point being is that we saw defensive rotation last week. Does that mean that we're basically throwing that out the window and rotating back to higher beta sectors of the market ahead of financial earnings, ahead of key inflation data points this week? And in fact, if we look at what's coming up for the week, we'll bring a Forex factor here. We've got CPI on Thursday. Now, Bostich explains that we're getting close to that 2% inflation target. Year over year is 3.2%. Month over month, this is the headline number, including food and energy, ticking up, expected to tick up from last month. Core CPI expecting to slip from last month. Both of these numbers on an annualized basis provide a number that's higher than the Fed's expected target. And the fact of the matter is, a 2% Fed, target inflation rate by the Federal Reserve does not actually benefit anybody. Who wants the purchasing power of their money to diminish 50% every 36 years? I'm using the rule of 72. 2% divided into 72, that means the prices are doubling every 36 years. Our incomes have not kept up over the prior 20 plus years. Why should we expect our incomes to keep up with that in the next 20? And by the way, we're using their ways or means of calculating inflation, which tends to be relatively self-serving. And Friday, we've got PPI data. Okay. Also on top of that, Friday, Jan 12, we're starting to see financial earnings kick in. So financials have had a nice run here, trading at new 52-week highs today. Well, what companies are coming up this week and announcing earnings? Let's look at Citigroup. Citigroup is announcing on Friday. What about JP Morgan? JP Morgan is announcing on Friday. Two big banks that are announcing at the end of the week at a potentially a pretty key options expiration. We'll have to see how this plays out. So the point being, as we circle back here, and we're going to look at the volatility indices right now, but the point is, do we want to buy into the fact that the market generally is poised to take off from here? The reality is, that's probably not the odds-on bet. However, if you're looking for stuff that may likely perform with the market, if we do get there, Amazon, Microsoft, some option activity in Microsoft, a roll at a higher strike price at $350, which is now, I guess, in the money right now. But the point is, Microsoft and Amazon may move higher with the market just sympathetically. But the point is, do you bank on the market making a major rally right now? The answer is probably not. Okay? That's not what I'm expecting. And the fact is, if we look at the volatility markets, let's look at the VIX. The VIX right now is at 13%. Can we grind lower? Yeah, maybe we could get down to 12.5, maybe as low as 12. But if we look at this perspective using 3-month volatility compared to 1-month volatility, and I got to bring up my ratio or relative strength line here using the pairs ratio study, notice this is up here about 115. It's not like the VIX got smashed today. Is there room for this to go to the upside? Yes. But what we saw at the beginning of last week was the beginning of more of a significant rotation. And I don't think we're going to go back to cyclicals and technology, but more than maybe a couple of days. This line needs to reset down here. Okay. We need it below 1. Now, previously here, we didn't quite get there, but the VIX futures did dip into backwardation. Go to product depth here, right? Notice the line is rising right now. Backwardation, the line will be sloped that way. This is about 14.75. That's about 15.75. We'll just round it to 15.25. The VIX right now is where? Go back to the VIX. The VIX right now is at 13. 15.25 is 2.25 points above 13. Divide the two, right? So I take 2.25 divided by 13. That is about 17%. Meaning what? That the VX futures, taking a 30-day weighted average, that we're not exactly because I took a straight average, but it's about what? It's about 17% higher than the spot VIX looking at the same 30-day time frame. And what this tells us is the market's predicting or expecting higher volatility, and we've yet to get it. Now, why is the VIX not moving higher? It's not moving higher is that the market's already been hedged for a pretty long period of time. The skew index has been north of 130 now for many, many months, almost 10 months now, 8 months. The point is there's been a significant amount of hedging beginning last April, all the way up as the market rallied off of its lows. The point is their institutions generally are delta comfortable. They're okay if the market goes down. Yeah, we were oversold. We're getting a rebound today. Virtually all the sectors except for energy, which recovered off its lows, was higher today and rather significantly higher. So the point is, do we really expect to see this continue? That's not the odds-on bet. If we look at the volatility markets, they're comfortable with the market going up or going down. We've yet to see that bigger sell-off and a spike in the VIX. But the reality is the road from here, if we move higher, is going to be rough. And the fact is we did not get anything. And there's a couple other Fed heads announced or talking this week that may push the market. We've got a financial earnings on Friday. Citigroup, JP Morgan, namely, they're announcing earnings on Friday. They could move the markets. It's going to be a tough grind here since we are currently above the expected move for these specific sectors that outperform today. All right, so while we may look at some bullish trades right now, we've got to be aware is that, look, it's going to be a tough road to hoe. Now, again, could we see a little bit more room to the upside in technology? Yeah, we can. right? We're not even back to the opening price last week, the beginning trading day of the year, last Tuesday on the 2nd. We're not even to the opening price there. We're not even to the close the Friday before New Year's. Well, it's not New Year's Eve, but the Friday before New Year's. We're not even back to those levels yet. Yes, we could eke out some more here. Now, what is spurring this on? Certainly NVIDIA today, right? NVIDIA saw a big breakout news. They're trying to make chips that are compliant, that they can export to China, yada, 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 right? The technical trend here, high, equal highs, higher lows, breakout would indicate what? The range from about 450 to 500. It's a 50-point range. 550 is in target here. We just gobbled up almost half that move today. Just to put that in perspective, off of the measured move here from the ascending triangle. Now, again, if we look at the trade on NVIDIA today, we could come down here, look at option statistics. Kind of balance, a little bit more at the ask. We're definitely sizzling today. More puts being sold, calls being bought, a lot of it occurring between the market. Is there a trade to set up here? Now, the volatility kind of flattens out as we approach 550. Could you look at something to the upside? 535, 540. Well, that's going to cost you about 205 on a $5 spread. That's 295 upside. 295 upside for 205 of risk. It's not necessarily a terrible trade, right? It's priced about fairly. Not necessarily a huge edge in there. If we get to 540, 550, you have a chance to maybe close it out this week for maybe a 50 to 70% gain if we were to post 550 plus this week. Not terrible. MU today. Micron. Now, Micron did fade a little bit from the highs, but its recent high is at about 88. Again, the options activity is relatively short dated for this week, but you can see the 86 strike here, mostly bought. Could you construct something here? Again, the target is looking back at prior highs at 88. Could you buy the 86 and sell the 88? Yeah, the vol skew is actually somewhat favorable. Right? They're not really being hurt by buying the higher vol and selling the lower vol. Again, it's about a 50-cent difference there. Could you buy an 85 and sell an 87? Yes. Right? That gives you maybe about a 75-cent cost on a $2 wide spread. If you can get to a 70% gain this week, 50 to 70% gain this week, probably shut it down if we hit prior highs at 88. Intel today, INTC, catching a bid. Prior high, 51. We're looking at getting back to prior highs if we look at these kind of trades resetting for the week. Yeah, it doesn't mean they're going to, but again, it's an expectation. Intel today, again, similar going for February. The vol skew, there's not a whole lot there, is there? You could buy the 49 and sell the 50. It's going to cost you what? That's a 55, sorry. You could buy the 49, sell the 50, or buy the 48, which is slightly in the money. Buy kind of an out type spread. Buy the 48, sell the 50. It's going to cost you about $1. A little bit less than $1 on a $2 wide spread, $1 of upside. If you get 30% on that, close it this week. Probably get there if we get to 51 this week or 51.5 on Intel. So the point is, or you could go SMH, the semiconductor ETF, targeting the prior high. So feeding in today's leadership, again, and probably, again, we're looking just for momentum pushing into the highs by the end of this week, gives you a chance to close some of those out. Okay. SKX. It's a retail stock, right? SKX. Consumer cyclical stock up 4% today. Do we piggyback off that? It was a phenomenal run. We're looking at prior highs at 64. We're currently at 63. We'd need something to push through. On SKX, this was a Jan expiration, 7,000 contracts at the 65 strike. This provides a potential target at 65. Now, if we look at February, the downside is we got $2.50 and $5 increments. However, we got $2.50 for Feb. The 62.50 is effectively at the money. Costs you about what? About $1.15 on a $2.50 spread. Risk $1.15, make $1.35, max gain, max loss. If you can get about a 30 to 50% gain on that this week, look to close it out. 65's right there. It's also a gamma level. We start to break through, could push it. Okay? Gamma level based on what? The activity we're seeing right here. It's a big move in Skechers today. And finally, XBI. XBI, huge move, significant breakout in the bigger picture here on an area that's much more oversold, but the highest close we've seen since middle of 2022. How do you take a flyer in something that's moved already so greatly? Well, we got to see what? Probably see positive vol skew. And again, you notice out here it starts to level out here about 97. Again, 97's up here. Well, again, you can take a low probability trade looking for some bigger moves in the coming months. 96, 98. Cost you about 75 cents. The vol skew is pretty flat here. The vol smile or whatever is pretty flat. 96, 98. Again, cost you about 75 cents. 98's right up here, right? That's a big move, but not a tremendous move to get there. And you've got 67 days to do it. If you can make 30 to 50% of that in the next week, you probably close it out. But these are some opportunities to the upside, looking at some bigger picture plays that tie into the S&P, Amazon, Microsoft. We're looking at semiconductors and healthcare in terms of biotech. And of course, Skechers in terms of consumer cyclicals. Anyway, folks, we'll see how this week shapes out. We got a lot of news coming up. We'll catch you back next week. Thank you.